Thank you, Oscar. Thank you for coming and being here. And go right ahead.
Good morning, everyone. Can you guys hear me? Yeah. Now, so I'll try to speak loud because I sometimes, without mic, it's sometimes might be a little bit hard. And I apologize for being a little late today. I actually went over to the other office at Piazera in Chula Vista. And they told me, oh, it's actually here. That's my confusion. I think I've been here in this office before, but maybe the rain. Maybe it's the rain. So thank you for inviting me. And I know it's the year end. Of course, we have 11 months of ups and downs in the market, and not only in the housing market, but in the financial market as well. I'm sure you guys are eager to find out what's going to happen. Now, before we talk about the housing market, obviously we need to talk a little bit about the economy. I think people get more and more interested in the economy in the last maybe 12 months or 18 months because of what's happening with the inflation and with what's happening with the job rate and the job numbers and the economy, whether we're going into recession or not. So today, for the first 20 minutes or so, I'm going to talk about the economy, give you the big picture. Now, I have slides. I have about 50, 60 slides, and I will send it to Monica, and Monica can feel free to share it with the audience here. I also will have it posted on the CRM website. At the very end of the presentation, you will also see my email address. In case you cannot get a hold of the slides for whatever reason, feel free to send me an email. And also, you can ask me questions via the email address if we don't have a chance to address those questions. So let's take a look at those the big pictures, and I put some bullet points up there. There are a couple of things we are going to cover on the economy. We're going to talk about obviously inflation. Inflation has been an issue, has been the focal point of what we have been talking about. That affects interest rates. It affects a lot of things. It affects buyers' desire to buy. Then, of course, inflation affects the economy as well, with interest rate at a high level, not only for the housing market, but for other prices in, maybe, for example, food and energy prices. They have been affecting the economy, and there have been discussions about whether we are going to recession or not. And I will talk about that. And obviously, interest rates. Interest rates have been affected by inflation. What's the rate today right now? 30 years, maybe about 7.25, something like that. And of course, we're afraid that it may actually go even further, up to maybe 8.5. I'm going to tell you whether that could possibly be a case or not. And if that is the case, what is the peak going to be, and what's going to happen after that. Then we're going to talk about the market. We're going to spend maybe about 20-25 minutes to talk about the market. We're going to talk about I always talk about the big picture first, meaning the state number, and I'm going to talk about the county level data, and I have some individual city level data as well. I may not have every single city that you guys are interested in, but I will show you where you will be able to find some of those city level data if you're interested in getting more specific local statistics. Obviously, we're going to talk about sales, we're going to talk about price, and we're going to talk about supply. All those are, variables that we want to cover and make sure that, we understand where it is right now and what direction it is going. So we're going to talk about, in the last 15, 20 minutes, we are going to talk about the outlook. We're going to combine everything, and we're going to talk about where we're going in the next few months and where we will be going in 2023. So let's get started. Let's take a look at the economic outlook first. Now, as I mentioned, we will talk about inflation. Well, inflation has been a variable, a significant variable that has been affecting everything in the housing market, including, of course, interest rates, as well as, whether people believe the market is going to continue, whether people believe that, prices are going to go down and things like that. So let's take a look at those two graphs. Now, on my right-hand side, you see that graph that shows you two lines, one blue line and the other one is a green line. The blue line is what they call the headline inflation number. That includes everything And then the green line is the line that includes just the core, that's called the core inflation number. That's the line that actually excludes food and energy. Now, why do they exclude food and energy? Those are variables that are more volatile. At a seasonal level, sometimes those are fluctuate a little bit more. And of course, when you want to look at the true inflation, the core inflation number, usually economists take those out. So take a look at those two lines. If you look at the blue line actually started coming back down a little bit. At one point, it actually hit 9%, and currently it is at 8.2%. We will be seeing some new number in a week or two or so on the latest inflation number. Now, what is 8.2%? Maybe someone can help me. Before the pandemic, what is the general inflation level? What percent was it at?
4.
Someone's at 4, someone's at 2. Well, I'll tell you this, between maybe about 2010 or so to about 2020 or 2019, we have been fluctuating at around 2 to 2.5% or so. And 2.5% compared to what we're at right now, 8 or 9%, that's a dramatic difference. That's a significant difference. And it affects interest rates. Obviously, it affects interest rates. Now, why are we seeing such a significant increase in inflation? Well, I can tell you, there are many different reasons. One of the most recent reasons for increase in inflation is because of energy prices. Compared to a year ago, when you go to the gas pump right now, you're probably paying about what? $1, $2 more per gallon, right? And on my way here, I think I saw maybe $5.50, $5.60 or so for the regular, and then at one point it went all the way up to $8 or $9, right, per gallon. Earlier, maybe about 2 months ago or so. Take a look at the chart on the left-hand side. That chart is produced by or generated by AAA. It gives you a sense of what gas prices have been over the last maybe 3 years or so. You see that red line right there? That actually peaked at around maybe about $5, $5.25 at some point, maybe about 2 months ago or 3 or 4 months ago in June. And then it started coming back down. Now, that's one of the reasons why we're seeing inflation slowing down a little bit in recent months, in the last couple months, coming back down from 9 to 8.2%. But that's also the reason why, one of the big reasons why we're seeing inflation at such a high level, because gas prices have been high. But it's not just gas prices, but all energy prices. It has something to do with, partly because of the war between Russia and Ukraine, because Russia is a country that actually supplies oil to the global market. When they're at war, of course, they don't have as much supply. They actually don't put much oil in the market, and that's why we have a supply shortage. Just like the housing market, right? When we don't have enough housing, we have home prices at a higher level. But there are other reasons as well, and that's why you see that green line going up, and then dip a little bit, and then start going up again. The green line on that right-hand chart shows you what I said earlier, the core inflation. That takes out food and take out energy. So even when we actually take out energy prices, that number continue to go up or stay at a high level. And the reason why it stays at a high level or has been at a high level is because of supply constraint. Now, in the past 2 years, when we had a shutdown back in 2020, when we had a lockdown, we also received some stimulus. We also received some fiscal stimulus from the federal government, from the state government. But at the same time, we might not have been able to actually spend some of those money because we were in a lockdown mode. But then after that, people started spending a little bit more. At the same time, we had been in pandemic, maybe even as of now, but we had been in the pandemic, era for 2.5 years or so. And that affects, manufacturing activities as well. Factories have not been producing as fast. I'll show you some of the numbers. Delivery times actually have been slow, meaning from the factory to being delivered to the shelf, it actually takes a little bit longer time during that pandemic era, and that's why we have been having some supply shortage. Now, I'll use a practical example in the housing market. We have not been producing as many homes during that period of time because of, partly because of the shutdown, but partly also because of the labor supply. But what about lumber and all those raw material for building houses? They have been jumping at a high level too. And that's why, those costs have been rising quite expediently in the last 2.5 years. Then the Federal Reserve have to jump in because they need to control inflation. Because if we can't continue to have high inflation like the last 2.5 years or so. Now, some of you probably have been in the business for maybe 30, 40 years. Maybe in the 80s, maybe in the 90s. Some of you may have remember what the inflation or interest rates were like back then in 1980s. Some people may not know, but if someone who worked here in the 80s, tell me what the interest rates were at that time. 18, 19%, right? Now, of course, we all complain about, well, 7% is really high, but remember what happened back in the 1980s. We were actually at 18, 19 at some point. Probably not all the time for like 2-3 years, but we actually reached that level 18, 19%. So, and partly because of what the Federal Reserve actually did back then. Federal Reserve, the activity or the Federal Reserve actions on their Fed funds rate actually have an impact on overall interest rates on the 30-year fixed rate. Why? Because the Fed funds rate is actually the interest rate that the Federal Reserve or the central banks loan to all the other banks. It's a short-term loan. It's not exactly a long-term loan, but their interest rates does have an impact on the overall interest rate level. And now, before March 2022, at the beginning of this year, we actually had Fed funds rate at a rate, if you look at that column on the far right, or far left, on my far left, you see that Fed funds rate target range? That Fed funds rate target range gives you an idea of where the Fed funds rate is. Before March, the rate was at 0 to 0.25. I don't have those listed here. But the first time that they actually raised the rate was March 17, 2022. They raised it by 25 basis points. And then you can see from that point on, they continue to raise rates. 6 times already. 6 times total in this year. And the last 4 times that they raised rates, they have been pretty aggressive. 75 basis points each. If you look at that rate, that means in the last 6 months, or actually 5 months or so, they raised their Fed funds rate by over 300 basis points, 3%. That's why at the beginning of the year, we were at 30-year fixed rate was at 3%, below 3%, right? And someone just told me earlier that it's at 7.25 now. Now, it may not go according to just what the Fed funds rate, Federal Reserve have been doing. In fact, they're anticipating, the market has been anticipating what the rates will actually end up being at the final or the peak level. And that's why it's actually rising a little faster. Now, typically, the way I usually look at this, if you look at Fed funds rate, the current level of Fed funds rate, you're at maybe about 200 to 250 or even 300 basis points to it. That's where the 30-year fixed rate is. That's where the 30-year fixed rate, long run 30-year fixed rate is. So in November, that's what they raised. That's the last time they raised rates. But they are going to raise rates one more time. They're going to meet up. The Federal Reserve will meet one more time in December. That's their last time. They typically meet about 7 or 8 times each year. The last time they're going to meet is December. Now, there have been a lot of speculation as to what rate or whether they are going to the Federal Reserve, whether they are going to raise rates again. I think most people in the market believe the Federal Reserve will probably raise the Fed funds rate by 50 basis points. So if they actually raise rate by 50 basis points, so it's consistent with what the market's been thinking, then that's okay. The rates probably will stay at a similar level as what we're seeing right now, maybe a little higher. But what if they actually raise rates a little higher? By 75 basis point or even maybe 100 basis point, if they cannot control, if inflation has not been contained by then take a look at these charts. Now, on my far right, that's a chart that shows you what people in the market believe the Federal Reserve will do in December. We look at those odds back in September, back in late October, and the beginning of November. Now, as I mentioned earlier, right now, let me go back really quick. Oops, sorry. Right now, the range is what? 3.75 to 4, right? So, what is the chance of, what are the odds of the Federal Reserve raising it by, let's say, from 3.75 to 4 to a level like 4.25 to 4.50, which means they are going to raise rates by about 50 basis points. Now, if you look at September 30th, at the end of September, the odds of them raising to 4.25 to 4.50, 50 basis points, was about 54%. And you can see that number continue to stay at around 60% at the end of October. And even as of about 10 days ago, or actually 5 days or 7 days ago, the November 2nd, look at that third column, 425 to 450, still at 56%, meaning half of the people in the market still believe they are going to raise rates by 50 basis points. So there's a good chance that they probably will. Now, I can tell you that in between now and then, there are a couple reports that will be releasing. There will be some reports on inflation, 2 more reports that will be released about inflation, and then a couple other reports on the job market. So the Federal Reserve, they're going to look at those before making a decision. But generally speaking, most people believe, well, they're going to, at least half of the people, I should say, believe that the Federal Reserve will raise rates by 50 basis points. Now, what about February? That's not well, I said, there are 7 meetings this year, but that doesn't mean that they can't raise rate next year. Their next meeting is February. Take a look at the chart on my left-hand side, the one with the lighter blue bars. That also shows you, what they believe, what the market believes the Fed funds rates are going to land. If you look at in September 30th, the end of September, most people do not believe that the Federal Reserve will actually get to the Fed funds rate of 475 to 500, meaning the Fed funds rate at a high end at 5%, which is a high level, which means the Federal Reserve will most likely raise rates again by 50 basis points in February. Most people believe they will probably be done by the end of this year when it was in September. But take a look at what changed. Let's just skip over October. Let's go to November 2nd. Let's take a look at that bar at for that illustrate 475 to 500. Look at that number. That shows 49% right now, right? Or at least November 2nd. See how different it is compared to September 30th? That number jumped by 49 or 40-some%. That means after the last time the Federal Reserve raised their rates, people's mind changed. They believe now that the Federal Reserve will need to do more to raise rates, to keep inflation under control. So that's why the interest rates actually have been staying at a high level, even though it may not have peaked. It came back down like 3-4 weeks ago, and then it started rising again. Recently, I can't remember the numbers this morning, but it's at around 7.25, 7.5, depending on what source you look at. If you look at the Freddie Mac's number, which is sort of the gold standard, the Freddie Mac's number released every week. They release those numbers every week on Thursday. So 2 days later from now, we will see a new number. But if you want to look at or monitor the numbers on a daily basis, you should take a look at the Mortgage News Daily. Mortgage News Daily actually shows some daily numbers. And when you look at the Mortgage News Daily number, you get a sense of what the Freddie Mac's number is going to be. I sense that the number is probably going to get back to, for the Freddie Mac's number, most likely it will get back to 7% or so. Last week, it was at 6.94. The week before that was actually it was at 7.08. So it dipped, but then I think this week it's going to go back up. And the question is, where are we going to settle and where is the peak going to be? Now, the reality is the Federal Reserve is the US central bank. That's only one central bank that actually has been doing some work on controlling inflation. But we actually have a lot more central banks around the world doing the same thing because of inflation. Take a look at that chart right up there. US is one of them, Eurozone, meaning EU, UK, Japan is an exception, Canada, Switzerland, Australia, New Zealand. All of those central banks, they want to control inflation because it's a global phenomenon. So all of them will be raising rates. Some will be raising rates a little faster than the other. And that's why at a global level, we are seeing some interest rate increase. So it's safe to say that, yes, it is. We are going to have some and continue to have some higher rates in the future. I'll tell you exactly where that will be, when we get to the outlook part of it. Now, it also matters when it comes to consumers' expectation. Now, if consumers are actually a lot of consumers expecting higher prices, they're going to demand higher wages, and that's going to push up costs overall. So what are the consumers' expectations? Now, this is a survey done by the New York Fed. They collect number on a monthly basis, and here are some numbers. Now, the blue line, if you look at that blue line, it shows you their expectations, consumer expectation on prices a year from now. Now, you can look at that trend line and see that maybe about a month, 2 months ago, or 3 months ago, they actually have high expectation. They expect inflation rate to remain at a high level. But take a look at the last couple months. It's actually started coming back down. So that's good news because people realize, well, inflation could be coming down a little sooner, or coming down to a low level next year. Now that's good news, but at the same time, take a look at the red line and the orange line. The orange line and the red line actually start taking up. The red line is their expectation in 3 years of what the inflation is, and the orange line is their expectation in 5 years. So they actually expect inflation to continue 3 years later and also 5 years later. They actually expect that inflation number to be a little bit higher. Now, what does that really tell us? It tells us that, yes, in the short term, the inflation will probably come down next year, but the red line and orange line also suggest that for inflation to actually come back down to the level that we used to see in the past, it's going to take a little longer. So, good news and bad news. Now, it depends on a lot of things. Inflation depends on a lot of things. I mentioned one thing earlier about delivery time. How long it takes for a product to go from the manufacturing or the factory to the shelf. If the time it takes to deliver that is very long, that means we have a supply constraint. So take a look at these charts up there. I have a blue line and a green line and a red line. Those are our delivery time index. Now I know there are too many lines up there, but take a look at. I'll make it simple. If you look at the line right in the middle, that's a 0 line. That's the dark black line. That is the long run average. Anything above that line suggests that it takes longer to deliver a product to the shelf. Anything below that means it takes a shorter time. Shorter time means it's getting to the shelf faster, meaning not as much supply constraint. So from late to 2020 all the way to maybe mid of 2022, you see all those 3 lines remain at above the 0% line, meaning it takes longer to deliver a product compared to the long-term normal. But it started coming back down in the last 2-3 months or so. So that's a good sign. That's a good sign that suggests that things actually are going back to normal a little bit, but it does take time even though the delivery time they're shorter now, but it does take a little longer for that to translate into the price level. Now there's another indicator. This one is a little bit simpler to look at, but it's the logic is still the same. Anything that's above the zero line suggests that it's taking a little longer or have a little bit more supply chain pressure. This one is a variable that shows you supply chain pressure. Not just the delivery time, but it takes into account of all the different things like labor shortage and all those other stuff. Anytime that is above the 0% line means it is above the long run average, meaning it still has supply constraint pressure. Anytime it's below means it is getting better. You can see that it is getting closer and closer to the zero line, but we're not there yet, meaning we still have some supply constraint and it probably will continue on for a little longer. Now, when we have supply constraint, when prices are a little higher, what happens? Well, we have inflation, but at the same time, that might, with high inflation, with prices growing at 8 or 9%, and our wages have not been growing as fast, that actually cut back on some economic activity. People may not be buying as much because they don't have as much money. Now, wage growth has been growing at around 5 or 6%, but inflation has been at around 8 or 9, so there's a gap. And that's why people may not be spending as much. Now, take a look at this chart here. This chart shows you the retail sales number. That includes things like where you buy at Target, Walmart. Of course, we have 2 Prime Days this year, right? Amazon. We're going to have another Black Friday. With 2 Prime Days, you would expect, Amazon to be doing really well. But people may hear, some of you may be paying attention to the Amazon stock prices. You know that 2 Prime Days doesn't necessarily mean everything is going to be okay. In fact, I think they dipped a little bit. But I digress a little bit. Take a look at the chart here. This retail sales number, if you look at the very first section of it, the top section, it shows you retail sales month over month, or MOM, retail sales YOY, year over year, and then the retail sales percent change from January 2020. If you look at the September column, that's the latest number that we have. Take a look at that column. That column shows you the change in retail sales compared to the previous month in the first line, compared to the previous year, and compared to the pre-pandemic level in January 2020. Now, anytime we have a positive number, that's good. It means that it shows a growth, right? Take a look at the year-over-year number. The second line, it shows an 8.2%. That means we are actually seeing, in terms of dollar amount, higher economic activity. That's a good thing, right? Well, keep in mind though, the very first section is a set of numbers that do not account for inflation, do not account for price change. If you really want to know whether economic activity we have increased in activity, take a look at that very last bottom section, the real retail sales. If you look at the real retail sales, if you really look at the number of real retail sales year over year, you can see that number shows for September a negative 1.2%. That suggests to me that compared to a year ago, economic activity actually has come down compared to a year ago. But the good thing also is, if you look back at, take a look at the same line, the numbers from March through September. In March, it actually dropped by 6.3. Now it's dropped to 4, and then it's 4.5, 3.8, and so on and so forth. It's actually slowing down, meaning year over year, things are actually, it's still worse than last year, but it's getting a little bit better, So inflation has an impact on economic activity. There's no doubt about it. People are spending less, and that's the reason why when interest rate when the Federal Reserve raised their Fed funds rate, generally, economists believe, well, if you raise it high enough, eventually it is going to cut back on economic activity, and we will end up having a recession. Now, someone in the audience may be able to tell me, are we in a recession right now?
No.
I heard people said no, right?
Yes.
Yeah.
Someone said yes. Now, if economists usually look at used up some data to determine whether we're in a recession or not. There are some technical definition of what a recession really is. People usually look at the GDP number, the economic activity in the first and the second quarter. Now, I have those numbers on the far right-hand side again with those blue bars and orange bars. If you look at those numbers, take a look at those numbers. I know it's really hard to look at. In the last three lines, three numbers, the third to the last number, it shows I don't have it shown there, but it shows a negative 1.9%, and then it follows with a 0.6%. Now, usually economists, when they look at those numbers, if they're technical, one of the technical definitions for a recession is if you have a back-to-back decline in economic activity, then that could be considered a recession. And so we did have a back-to-back decline in economic activity in the first quarter and the second quarter. But look at the third quarter, the number that was just released earlier, about 2-3 weeks ago. It shows an increase of 2.6%. So that suggests to me that it could be a bounce back. It could be, economic activity rising back a little bit more. Now, I actually don't believe that we had a economic recessions in the first and the second quarter when I first look at those numbers. And the reason why I did not believe we had a recession is because of the chart on the my left-hand side. Take a look at the chart. I know there are a lot of lines there. It might be confusing. Now, each of those lines shows you sort of the pattern of each economic cycle on the payroll employment. How the labor market is doing according to the time path of each cycle. So what those lines suggest is, when we get into recessions in the first month of the year, they usually stay at a low level. And then at some point, those gray line or black lines actually hit 100. You can see that all those lines cross at 100. That's the peak of each economic cycle. So anytime we hit a peak in terms of economic activity, we hit a peak, then those other lines, those gray lines or black lines started coming back down. Meaning, whenever you hit the peak of an economic cycle, after that, you would assume that people will be hiring fewer people. Employers will be hiring fewer people when we hit the peak. And that's what those lines suggest. When we hit the peak of each cycle, most of the lines suggest that we're actually coming back down after that. Now, there's one exception. There are two exceptions. But the exception that I want to point out is the red line. Take a look at the red line. The red line is the current business cycle, what we're going through right now. If it follows a similar pattern, that is, if we actually were in a recession, that red line should have actually come back down also after hitting 100. But take a look at that red line. That red line actually continued to go up. In fact, it actually has been going up at a very high level. That means after what we believe, if we actually had a recession in the first and second quarter this year, December of last year should be the peak. But after we hit, past the peak, the red line continues to stay at a very, very high level. That suggests to me that the market is actually still doing very well. We still have supply constraint in the labor market. That suggests to me that, we are not in a recession yet. Now, I said we had not go into recessions, but I'm not saying that we are not going to in a recession. We probably will go into a recession though. Now, first, let's take a look at the labor market. The labor market is still very, very strong, and that's the reason why the Federal Reserve continued to raise rates. And that is one of the concerns, because if the Federal Reserve continue to raise rates, then eventually they will actually cut, into the actual economic activity, and they have overshoot, which they tend to do in the past. Every single time, I should say. They tend to overshoot. And the non-farm employment right now, if you look at all those numbers, it suggests that things are still doing okay. The job growth number is still at a very high level, even though it's not as high as the last 9 months or so. Things are still doing okay. But the number that you probably should pay attention to is the average hourly earning, the third or fourth bullet point. The average hourly earning, that gives you an idea of wage growth. That actually has been increasing by 4.7%. Now, if I were to tell you your salary, you get a salary increase of 5% or 4.7%, that's pretty good, right? Inflation typically in the past was 2.5%, 3%. So 4.5%, 5% is actually pretty good. But like I said, inflation is actually rising at a higher level. And so even with a 5%, it doesn't seem like we're getting as much. But the Federal Reserve wants to keep that number down because that number also has a direct impact on overall price. So the Federal Reserve is hoping that that number will come down, and that will come down when we have actually fewer job demand or job growth. And that's not happening yet. But what's happening is, if you look at that chart actually on my left-hand side, that chart shows you the manufacturing activity. Manufacturing activity is one indication of where the economy is and whether it is actually coming down or not. To make it simple, anytime it's below that 50% line, that suggests to me that the economy is actually not expanding anymore. In fact, it's actually could be slowing down and maybe going to recession. And look at that line right now. It's actually approaching 50 or actually touching 50 right now. That suggests to me that maybe in the next month or 2 months or so, things are probably going to slow down even further. With the way that the Federal Reserve has been behaving, I think that's probably going to happen. Now, I'm going to tell you at the end where we're going to get to recession and how much. But let's take a look at the housing market first. Now, inflation has an impact on the economy. I already showed you that. But what about the housing market? Inflation definitely has an impact on the housing market. Everyone in this room knows. But let me tie in the correlation. First, let's take a look at some survey results. We do some surveys every month, and we ask some questions. We ask our members. This is a survey that we sent to our members, and we ask them whether inflation has an impact on the buyer's plan and their seller's plan. Take a look at those numbers. You can take a look at the first set of numbers. The answer to the question is, inflation is delaying my client's home buying plan. Look at those bars. Those bars actually continue to climb. Going back to May up to September, those numbers continue to increase, which means members feel it too. Buyers actually have been pulling back because of inflation. And because of inflation, and the reason why that is the case is because inflation, increased interest rates, and they also are concerned about whether about their job safety and all that stuff. Maybe not so much right now, but it's probably in the back of their mind. It also affects seller's plan. Look at the fourth set of charts. The chart that says inflation is delaying my client's home selling plans. It's not just about buyers. It's also affecting sellers as well. The reason, the way it affects seller is, of course, sellers also could be a repeat buyers. Sellers could be the one putting their house up on the market and buying a home and turn around and buy a home. But if interest rates actually stay at a high level, many sellers may not necessarily want to put their house up on the market. And I'll talk a little bit more about that. Some of you may have heard about it, what I call the lock-in effect. That is, if you lock in at a rate at 2.5% or 3%, you as a homeowner, if you have to buy or sell and buy, you actually have to trade up for a 5.5%, 6%, or 7%. Some people may not want to do that. Now, you also may ask me or wonder whether I have any suggestions on how to actually get buyers and sellers in the market. I'll talk more about that later on. But let's take a look at the market statistics. And I apologize, I only have data through September. We will be releasing our October number actually next week. But let's take a look at those September number, and I can talk about the October trend as well. Look at those numbers. These are state numbers. At the state level, if you look at the September number compared to a year ago, it dropped quite dramatically. It dropped 30.2% for existing single-family homes. Now, granted, of course, last year in 2021, we actually had a pretty decent year. We had very high level of sales, but dropping by 30%, that's significant. There's no way to sugarcoat it. It really dropped quite a bit. And take a look at the first 9 months. That's the year-to-date number, the YTD number. The existing home sales for the first 9 months actually dropped by about 16.5%. So we have been dropping quite a bit. What about price? Home prices, what about prices? Are they actually dropping as much? Because a lot of your clients probably are more concerned about prices than the sales number. Now we're concerned about sales numbers, but prices are what sellers and buyers are most concerned about. Take a look at the bottom section. It shows you the price level at the state level. At the state level, in September, we had 821,608. Now that still shows a year-over-year percent change of 1.6%. Now it's not comparable to what we had before. I think 6 months ago or 7 months ago, we had 8 or 9% increase. Now you can see that definitely has come down. But it still shows a year-over-year increase of 1.6, even though it's small. Now I'm going to clarify though. Your client probably will be asking you, well, how is that compared to the peak? The peak, we did have a peak. The state number actually peaked in May or June. And it reached, for the state number, it actually reached 900,000. So I'm not gonna lie, on a month-to-month basis, we did drop. For the last few months, it actually dropped from 900,000 for the statewide median price to 821. Now, there are a lot of different ways to interpret this. Part of it is because of seasonality. Usually in May or June, we have higher prices because we have people buy bigger houses. So obviously, every year we see a drop from May to June to November or October. So this is a seasonal pattern as well. But at the same time, we also notice that more people actually, in the first half of the year, we have people buying more expensive homes. Maybe because of, remember, the stock market earlier was actually still pretty decent, and recently it started dropping a little bit. People who are in the let's say tech industry, they tend to buy higher priced home, and so when the financial market started dipping, you see some of those high-end home sales going away, and that might actually change the median price as well. And obviously, high interest rates definitely affect the desire to buy. Buyers, there's no question about it. Buyers probably have a little bit more negotiation power compared to 6 months ago, right? Because people's homes are staying on the market for a little longer. Take a look at the median days on market. Homes are staying on the market for 22 days now. Now, if we take out the last 3 years, 22 days is actually not too bad, right? Compared to 3 years ago, 4 years ago. 22 days is actually not too bad. But we also remember in the last year or 2 years or so, some homes stay on the market for 5 minutes, right? Or maybe not.
Maybe not.
Maybe they will appear on an MLS after that, but that's about popular. We can talk more about that later. Now, here's a chart that shows you every price segment, sales of every price segment. You can see every price segment's actually dropped by more than 25%. Especially in the upper price segments, it didn't used to drop that much. It started dropping by 20, 25%, 27%. That suggests to me that it's affecting every single price segment. Some price segments in the low price segments, actually dropped by about 37%. Now, the low price segment dropping by that much, it's not a surprise because of tight inventory, tight supply as well. It's not a surprise, but also because of affordability. Now, here's a chart that shows you what the mix of sales change is. It might be a little confusing, but if you look at the green line right there, back in 2019, that green line is the share of $1 million home. It used to make up about 19%, and for the longest time until the lockdown, it was still making up about 19%. But then what happened? Interest rates started dropping quite a bit, and it's understandable to everyone here probably that during the pandemic, people who can work from home, they typically have actually a higher salary. For the service sectors, they typically are probably affected a little bit more, and they typically have salary that are a little bit lower, and that's affected their sales activity as well. And that's why, if you look at that green line, the share of home during the pandemic actually started rising. At one point, actually, it has risen to about 33%. And that actually changed that median price that I mentioned earlier. So the change in the mix of sales did change the median price. Now, right now, it's going the other way now because sales of expensive home actually started coming down. So it actually affects home prices. Now, the reason why I wanted to bring that up is even though if you look at the price change between the state median price at the high level, at the peak to now, it might suggest that we're dropping 8 or 9% or so. Part of it is because of the change in the mix of sales. If your client asks you about whether home price, how much home price might have depreciated, the actual price appreciation is less than that number. It's probably about if the price change right now in median price is 8 or 9. The actual price change could be about 5% or so, 6% or so. So the median price did have some, effect on it. Now, right now, if you look at that year-over-year percent change, as I mentioned, it's 1.6%. But if you look at that M-to-M or month-to-month percent change, it continues to drop. It continues to drop at 2.1%. So prices are definitely dropping, and it's partly because of interest rates, as I mentioned. Interest rates remain at a high level. And stay at around 7.25 or so. It came back. If you look at that blue line, it actually dipped a little bit in the last couple weeks, and then it started coming back up. Now, even with prices sort of slowing down in terms of the increase at 1.6%, take a look at that light blue line right there. What I'm showing you here is the change in price versus the change in mortgage payment. With increase in interest rates, you can see, if we go back a few more slides earlier, I said buyers definitely are affected by inflation because of interest rates. And here's the reason why. Take a look at the mortgage payment increase. Despite the fact that prices only increased by 1.6%, take a look at how much they have increased in terms of mortgage payment. It increased compared to last year by 48%. So that means if someone actually paid $2,000 last year for their monthly mortgage payment, they have to pay $3,000 for the exact same home, or maybe even smaller. Now, here's a chart that shows you, and I don't have the exact link here, but there's a link on a CREA website that I'll tell you later. But this chart shows you how mortgage payment actually changed, how the monthly mortgage payment actually changes over time, or over a series of interest rate increase between 2 to 3, 4 to 4 to 5 to 6%. Let's use an example of 3%. 3% for a $900,000 home, mortgage payment would have been $4,071. Take a look at what the number is for 7%. If it jumped from 3% to 7%, the monthly mortgage changed from $4,071 to $5,845. The difference is $1,800 each month. Multiply by 12, you can see how much money you actually need to make in order to get approved for a home, the exact same home. So that's why affordability actually has been an issue for buyers. Now, we have a chart, we have a dashboard on the CREA website that shows you, that you can play with on the CREA website, that you can play with, plug in the right number, 3, 4, 5, 6, 7% or so, plug in the household income, and gives you an idea of how much people can afford. It's on the CREA website. If you're interested later on, I can show you exactly where it is. And that number is not by state, it's by county. So you can actually look at the county level number and play with it. One of the nice things about that dashboard also is it also identifies the percent of housing inventory that you can actually buy. So it's not just a calculator on mortgage payment, but it also shows you the supply side. Now, the affordability here shows you how much people actually can afford. It shows you how much interest rates could increase mortgage payment. And it shows you a big picture. The blue line shows you the California number of the percent of households who can afford to buy. It dropped from 23% of all households in California who can afford to buy a medium price home to 16% just because of change in the interest rates. Now, here are some practical examples. We sent out a survey also on in the second quarter of this year. And we collected some information from first-time buyers. Now, the increase in interest rates have a significant impact on first-time buyers specifically. Take a look at the second line right there, median monthly mortgage payment, comparing this year and last year. Now, I show you a percent of an increase of $1,800 every month for a median price home. But for first-time buyers, they tend to buy a smaller home. And look at the actual change. They're actually, these are real change from first-time buyers. They actually increased their monthly mortgage by about $500. The reason why it did not increase by $1,800 every month is because they also put in a bigger down payment. Take a look at the down payment. Their down payment increased from $50,000 to $69,000 or $70,000 total. So a first-time buyer had to come up with $20,000 more in terms of down payment compared to last year. And let's take a look at the type of homes that they're buying. Even though they're paying more, take a look at the median square footage. Over the last few years, first-time buyers actually have been dropping in terms of square size of their home, dropping from 1,500 all the way back in 2019, all the way to 1,400. They're buying smaller homes even though they're paying more. And look at the type of home they're buying. Used to have more people buying detached single-family home for first-time buyers, not anymore. It dropped from 78.2% in 2019 all the way to 69.4%. Many of them are competing for condo homes, rising from 16% to 6%, 16.6% to 22.6%. Now, what about the percent of sales? First-time buyers used to make up a little bit more. 2-3 years ago, they used to make up 37-38%. Now they dropped to 33 or 34%. So in the upcoming year, we can definitely, one thing for sure is the share of first-time buyers will continue to dip to a lower level, maybe to 30% or 29%. So we will have fewer first-time buyers in the upcoming year. So it's something to think about because, of course, you continue to work with first-time buyers, and they probably need a lot of help in terms of how to get their financing and things like that. That number is actually dwindling down a little bit in the upcoming year. So as a realtor, probably have to think about how we can help them out. Now, what about repeat buyers? Repeat buyers are actually doing a little bit better. Take a look at those numbers. If you look at the monthly mortgage payment, you can see that repeat buyers, the number actually did not change. The monthly mortgage actually stayed the same, $1,668 in 2021 compared to $1,668 in 2022. How come? I mean, they're paying higher interest rate also, right? They should be paying a higher mortgage payment. But take a look at the down payment that they're paying. They're basically paying $50,000 more. How can they afford to do that? Well, take a look at this chart. This is a chart that shows you the equity gain in the last 2 years. The equity gain from 2020 to 2021 and 2022 definitely jumped significantly because of increase in prices. Their equity gain, on average, increased by $100,000. Of course, they can actually buy down a little bit, pay a little bit more on down payment, and that's avoid them to paying higher interest rates or actually borrowing a lower amount and maybe even buy down. So there are a lot of options a little bit more options for repeat buyers because they have a little bit more equity. For people who do not have as much equity, take a look at what they opted to use. Many people opted to use, more people are opting to use adjustable rate mortgage. Many of you probably already noticed fixed rate mortgage is great, 30-year fixed rate mortgage is great, but at the same time, adjustable rate mortgage is a little bit lower in terms of rates. So some people are opting to use ARM. You can see from here, that number jumped from somewhere around 6% or so to 12.5%. Now, still not as high as what we had before. Back in 2006, 2007, we go back, it was about 30%. And they were a little more risky back then. Today, it's a little bit better. What about the supply side? With interest rate rising, with demand actually going down, you expect more supply, right? You expect more people to put their house up on the market. Well, take a look at the active listing inventory. Yes, on the surface, I think we are seeing more inventory. We're seeing, in the last few months, total active inventory actually increased by 50-60% compared to a year ago. That's a good sign, right? But at the same time, let me ask you, you guys are in the field, as far as new active listing is concerned, are we seeing more new active listings? Are we seeing more people put their house up on the market?
Yes.
Probably a few. The reason why I think that is the case is, if you look at the chart on the left, on my far right hand side, that's new active listings for the state as a whole. That means the number of active listings being listed every single month compared to a year ago. Take a look at those numbers. The new active listings number actually did not increase. If you look at the green bar charts, they actually dropped from last year. So for most of those active listings that we are actually seeing on the MLS, they might be left over. They are carried over from the previous month. Yes, so buyers have more to choose from because we have more left over, but also because we can have a pullback in demand. If demand actually dropped by 30% that I showed you earlier, there will be more house on the market. So we have some tightness in the market still. And in a way that's a good thing because prices actually have not been dropping because of that reason. But the market competitiveness definitely has increased, has dropped. Now, one way to look at the market competitiveness is by looking at the sales to list price ratio. If you look at the peak number in April or May, you can see 72-73% of all homes sold back then at a sales price above asking price. That's a very high number. But look at the recent months. In the last month or so in September, that number actually dropped to 28-29%, meaning only 28% or a little bit more than a quarter actually offer a price above asking price. Like I said earlier, buyers actually have a little bit more negotiation power than before. That's why the number is actually dipping a little bit. And you can see from here, from this chart too. Have you encountered sellers, or have you advised your sellers to actually dip the price a little bit recently just to be able to sell? This is the number. The percent off listings with a reduction, with a price reduction, head up to about 45% now. That's the highest number that we've seen in maybe about 2 years or so. That's because sellers are adjusting to the market. Let's take a look at some county level number. Now here in the next few charts, I'll show you first the Southern California region as a whole, including LA, Orange County, San Diego, Riverside, San Bernardino, and Ventura. Southern California as a whole also dropped similar to the state at 32-33% on a year-over-year basis, and compared to the state, for the first 9 months, it's actually dropping a little faster, about 21%. But look at the year-over-year change in price. It actually is a little bit higher compared to the state number. So for Southern California, I think we're doing a little bit better in terms of holding up the price. But in terms of sales price to list price ratio, Look at the corner number, it's still showing a number that is below 100, meaning market competitiveness definitely has come down. I highlighted San Diego here. You can see these are the sales number, raw sales number of existing single family homes compared to a year ago and compared to a month ago. Obviously, it shows a drop on a monthly basis and a year-over-year basis. And it's dropping about 21% for the first 9 months of the year. Price-wise, San Diego actually is not doing too bad. It's actually still showing an increase of about 6% compared to last year, or close to 6%. And compared to last month, it actually inched up a little bit in September. Now, October we probably will see a slowdown because of seasonal change. And here are some numbers on inventory. Supply side still stay at below 3 months for San Diego, 2.7. Look at time on market though, or days on market. It is now about 19 days. Definitely higher than what we have seen in the past 2 years or so. But I'm showing also 17 and 18. Look at 17 and 18. Around this time of the year in 2018, it was at around 25 to 30 days, 3 years ago. So we're not, even though it has increased from 19 days to 19 days, it is still at a tight level. Now, here's the new active listings. San Diego, following a similar trend as the state, as well as the region, it is still showing San Diego actually dropping on a year-over-year basis in new active listings. But look at San Diego, it actually dropped only 5% compared to 19% in LA and even 28, 29% in San Bernardino and Ventura. So supply side, I think San Diego is doing a little bit better. And of course, the sales price to list price ratio that actually dropped also below 100%. Here's the housing affordability number. I showed you the affordability number for the state earlier. San Diego is actually on the right-hand side of the state. It actually is below the state level number. The state is at 16%. San Diego is less affordable in a sense compared to the state at 14%. Now let me show you really quick, the local market statistics. And I understand I may not have every city that you guys want to take a look at, but this is a chart. This is one of the charts that you can actually download from the CRO website. Go to the housing market overview and select your county. Once you select the county, it will give you a list of cities that you can choose from. This chart, and once you see a city, click on one of the buttons that says, let's say, PowerPoint slide. It will generate a one-pager that you can actually download and use it or pass it out to your clients and use it in your PowerPoint. So, and it has all the cities, well, I shouldn't say all the cities. Most of the cities that you would like to see. So I picked a few cities, I think 6 or 7 cities that I believe you may be interested in. It shows a similar story. Price for most cities actually continue to climb. Sales-wise, it's actually dipped. There's no doubt about it. We're seeing 20-30% decline. And active listings, it shows an increase, but that's overall active listings. Remember, it's not new active listings. And most of them, you're going to see a sales to list price ratio actually below 100. Now, El Cajon, of course, showing a similar story. I'll skip to the next one. Escondido, similar, an increase in price, dip in sales, and active listings actually increased by 94%. Take a look at that. Active listings with a reduced price. That actually increased by 40% or so. La Mesa, similar story. Quickly, Lakeside, drop in sales, but prices are holding on. The active listings with price reductions actually increased by 65, not increased, but at a 65% level, meaning sellers are aware that they have to actually make some changes. Same for San Diego, City of San Diego, Senti. It looks like home sales actually hold okay for September. And Spring Valley, again, similar story. And then that's it actually. Now, again, I only have 7 cities on there, but you can actually find those cities all other cities, even for LA or other counties, on the Sierra website, housing market overview. I'll show you on my phone later on if we have time, where you can find those numbers. And it's not just PowerPoint. So I'm showing you the PowerPoint slide format, but it also comes with Instagram format, and also comes with as a one-pager that you can actually hand out. So let's take a look at what we can expect in the upcoming months, or in the upcoming year, in 2023. Now, what should we expect for 2023? We know that things are actually slowing down a little bit, and it will continue to slow down in the upcoming year. You can actually look at the charts on my right-hand side and get a sense of whether we will be able to control inflation, because that's the most important factor. Being able to control inflation means we will be able to have an idea of where the interest rates will be. But take a look at the inflation number. Again, I have two sets of data. The headline number, which is CPI, and the core CPI is a set of numbers that shows you the inflation without the volatile items. Take a look at those red bars. Now, right now in the third quarter, we have a number. If you look at the CPI number, the third quarter number is 8.3%. You can see from those red bars that they will continue to decline, which is good. We're seeing some declining trend, which is good. But take a look at what happened at the end of 2023. At the end of 2023, we will still be at 4.3%. Remember what I said about pre-pandemic level numbers? It was at 2 and 2.5. We're not going to get back to that level until earliest, maybe 2025. Because at 2024, you can see it was still at 3.1%. That means, at least for interest rates concern, the Federal Reserve will probably do a little bit more. I'll explain a little bit more when we talk about that chart with a lot of dots. If you look at the core CPI chart, you can see it follows a similar trend. It actually will get back to 2.6% at the end of 2024. So things are going to be improving, but it will take a little longer. That's why remember what the chart that I showed you, the consumer expectation. They expect, next year things are going to get better, but it's going to stretch out a little longer. And it's not just me thinking about that, or just the consumer. Take a look at that chart with a lot of dots. That is what we call the dot plot. That is the Federal Reserve. So each dot represents a vote of each Federal Reserve official. Each meeting, or every 2 meetings, they will submit a vote and speculate on what they believe the year-end number is going to be. So you see 2022, 2023, 2024, and 2025. So each of them submit their vote, and then we get a sense of what the median or the average is. If you look at 2022, in September, most of them believe it is going to be, the average is going to be at around 4.4% for the Fed funds rate. These are the Fed funds rate numbers. The target range that I showed you earlier, that's a Fed funds rate number. So 4.4% is what they actually expect. And that's in September. The November numbers, they did not release, but it's probably going to be a little bit higher, probably at 4.75 or so. But what's important is to look at that red line. In 2023, take a look at that 2023 number compared to 2022. It suggests to me that that number will continue to increase. So in 2023, we probably will continue to see the Federal Reserve increase Fed funds rate a little bit more. Now, that number, of course, is a yearly number. What I believe is going to happen is they're going to continue to increase Fed funds rate in the February and maybe the next meeting, which is in March or April. I think it's late March. I can't remember the exact date. They might actually increase Fed funds rate twice in 2023, and they probably will keep it for a little longer at the same level, and they may actually start dropping. The reason why they have to drop it is because here's coming. I told you that where I would tell you where the recession is. It's probably going to be in the second or the third quarter. We'll probably start seeing the second quarter or third quarter economic activity start coming down, and the Federal Reserve will actually have to do something by holding off on increasing interest rates or maybe even dropping the rates. That's why in 2024, 2025, you will see, rates start dropping. And the reason why things are actually going to drop is because it's not just consumers. I mentioned about consumers. I know consumers are expecting, okay, well, things may not be as good. I'm not going to buy as much. But it's not just the consumers. Business leaders are having the same issue as well. Business leaders, take a look at the chart with the line. That's the CEO confidence. That shows you, the confidence level of CEOs or business leaders. It has been declining for the last maybe 12 months or so. It suggests to us that CEOs are less confident about the economy compared to before. What does that really mean? Well, actually, let's take a look at that chart on the right-hand side, on the left-hand side also, to get a sense. That chart shows you 85% in the fourth quarter, or beginning of the fourth quarter, 85% of the CEO believe that we're going to have a brief and shallow U.S. recession. Now, some actually believe we're going to see a deep recession. What do you think the business leaders are going to do, or CEOs are going to do, when they think that we're going to a recession?
Laying off jobs.
They'll be laying people off. They could be cutting back on business spending. So what they think actually is very important. Look at what happened to Elon Musk. Right? He just laid people off with just a tweet. And we are hearing, business leaders are going to actually cut back not only on hiring people, but also on business spending. So that will actually lead to overall economic activity slowing down. When that happens, obviously, we will have a slowdown in economic activity overall. And some of you may have seen this. This is called the yield curve. Anyone familiar with the yield curve? Some of you may know what that is. I'll make it a very simple term. Yield curve is when we look at a yield curve, we look at the difference between the 10-year bond interest rates or 10-year bond yield versus 2-year bond yield. Now, that's the difference. So let's say if the 2-year is 3% and 2-year is 1%, we see a positive of 2% or so. Look at it from this standpoint. 30-year fixed rate versus 15-year fixed rate. Typically, a 30-year fixed rate has a higher interest rate than a 15-year, right? Well, the reason why they're a little higher is because when someone borrows money for a little longer, there's a little more risk. So you charge people a little higher. Banks charge people who borrowed a little longer, a little higher compared to the shorter term. Same applies to the 10-year to 2-year yield. 10-year bond usually has a higher yield than a 2-year yield. Now there's something called the yield curve inversion. That is when that difference between 10-year and 2-year actually drops to a negative number. In that case, that usually means people are charging a higher yield on a 2-year than a 10-year. What does that really mean? As I said earlier, usually people charge the 30-year rates. The 30-year loans get charged a little higher because it involves a little more risk. Now, the yield curve inversion, if the 2-year actually is higher than the 10-year, that means the 2-year, if people were to borrow something for 2 years, a lot of people consider that a little bit more risky than actually borrowing for 10 years. Why is that the case? That is usually the case because people think that in the short term we're going into a recession. That's why every single the yield curve the yield curve inversion is actually very good for predictive for recessions because the market dictates it. They're having a higher number on a 2-year than a 10-year. That's because they believe there's more risk in the short term. And the yield curve inversion actually we actually had maybe about 60 days of yield curve inversions for the last 2 months or so. So that suggests to me that, yes, we're probably going to go into a recession in the next 12 months or so. So here are the numbers for the economic outlook. My prediction is in 2023, if you look at the very first line, the economic activity, we're still going to edge out with a positive number in 2022, but in 2023, we're going to a mild recession of 0.5%. Mostly, it's going to be in the second quarter and the third quarter. And the non-farm job growth. The labor market, it is also going to drop slightly at the US level, 5.5%. And the unemployment rate, it is going to go up from 3.7 to 4.4. But look, if you look at it from this standpoint though, 4.4 is actually not a bad number. You look at how it compares to 2021, 2020, even the pre-pandemic level. In 2017, we were at 4.4. And in 2016, we were at 4.9. So 4.4 is actually not a bad number, but it is a slowdown. But look at the CPI number. I know that number is probably a little more conservative. It could be a little bit higher. The CPI number, that is the inflation number, it is actually at 4.4%. So in 2023, things are actually going to look a little slower. Now, California is going to be a little bit better off compared to the US. The reason why that is the case is because California is an area, as a state, with a lot of tourism. And I think we are actually getting better at the opening up the international travel. So we probably will have a bit more travel or tourists coming to California in the upcoming year. That actually could help the economy a little bit. And you can see non-farm job growth actually adds up with the 1% in 2023 for California. Will continue to grow. And unemployment will actually improve. It will actually increase to 4.7, but that's not a bad number at all. I'm not going to talk about population growth or migration because that's another whole discussion. Now, in terms of sales, buyers, here are some numbers based on pending sales and based on mortgage applications. Based on our pending sales, which by now is probably numbers that you already know, which means those are numbers that are being turned into closed sales. I believe in October and in November, we probably will continue to see some decline in sales, closed sales in October, November, and also December. And it could be big, 30%, 35% for the next couple months or so. Because look, interest rates actually have risen to about 7%, and people might be holding off. And you can see that mortgage applications also dip. The orange bar, that's this year's level. And then all those lines are 2019 through 2020 level or 2021 level. So you can see we actually have been staying at below previous year's level since maybe about March or April already. So people are not buying for because they're concerned about the interest rates. But we also have supply constraint. We also have structural issues. If you look at some of the supply constraint, builders. If you look at those blue lines, the chart on the right-hand side, it shows you California housing permits versus the demand. You can see those blue bars. It increased in 2022 and maybe in 2021, but in 2023, things are actually going to slow down. Why? Because, buyers are concerned about the housing market, but builders and developers also are concerned about demand. So they may not necessarily build as many single-family homes, but developers and builders may be actually building multi-family homes, maybe building apartments. So they're shifting. And on the left-hand side, that years owned homes before selling, that's how many years a seller or homeowners hold on to their property before selling. It actually shows that they have been staying at around 10 years or so. Next year, the number could actually go up because of what I said earlier, the lock-in effect. It's unless they really want to sell, some sellers will be actually holding on to their property. They may actually renovate. They may actually not want to put up their house on the market and then trade up or trade down for a higher rate. So that's the reality. That's probably what's going to happen. That's probably what's going to happen in the upcoming year for many sellers. Now, are we going to see some of you? I know I always have this question. One person in the audience always asks whether we're going to see more foreclosures, whether we're going to see more REOs. Now, some of you may have been through the last housing market collapse. And you probably know 15 years ago, we had a lot of foreclosures, we had a lot of REOs. In fact, I believe at one point, foreclosures and REO actually makes up about 60% of all sales. Now that's because of people being underwater. Take a look at the numbers here. These are numbers released by CoreLogic. It shows you the share of mortgages that are underwater right now. Take a look at the number for California. Only 0.6% of all mortgages, at least in the second quarter, were underwater. Now, I'm going to ask audience here, what do you think that number was back in 2009, 2010? How many mortgages were underwater?
14%.
14%. Someone said 14%. Any other number?
50%.
That's not quite 50%, but we're getting closer. Last time in 2009, 2010, the percent of underwater mortgage was 30% for California. So if you look at that number compared to what we had before, you'll realize that that's why I don't believe we're going to get this. Even if we were to drop by 5% in terms of price, the number may actually increase. That number may increase from 0.6% to maybe 3 or 4% or so, but not to 30%. And the reason why that is the case, take a look at the survey that we have, survey results that we have here. Back in 05, 06, before the market crashed, how many people actually put down 0% down payments? We had a lot. You probably have dealt with some first-time buyers who actually purchased at home without a down payment, and their mentality was, well, prices never go down, right? I mean, that's what the mentality was back then. And 0% down payment, it was 20% or a little over 20%. Take a look at the last few years, 2021, 2022, 2020, the percent will be down 0% down payment, much lower. And adjustable rate mortgage, second mortgages, if you can actually secure a 3% 30-year fixed rate, you don't need a second mortgage or an adjustable rate mortgage. Take a look at the percent who actually used those mortgages back then. Significantly higher than what we are at right now. Those are considered more risky loans. And that's why today, even if, let's put things into perspective. In the last 2 years, home prices have increased. Forget about the last few months. Home prices have increased probably compared to 2020, by about 30% in general. If someone were to buy a home with a 10% down payment, and their home prices actually increased by 30% or so, they probably have about 40% equity in their home. They're not going to turn their keys back to the lenders, even if we actually have prices drop by about 10%, 12% or 15% or so. There will be some that actually will throw their keys back to the lenders, no doubt about it. So we will see some increase in foreclosures, there's no doubt. But that doesn't necessarily mean that we're not going to see a drop in price. Hate to say that, but we're going to see some drop in price. Take a look at our housing market outlook. In 2022, we actually will see a drop in sales by about 19% compared to the previous year. And in 2023, that number will drop further by about 7% or so, 7 or 8% or so. Take a look at the median price though. Median price actually will show an increase of close to 6% this year. And next year, we will see about 8 or 9% drop compared to this year. Now look at that number compared to 2021 number. It is below 2021 number, but look at how it compares to 2020. It's still higher than 2020. So if a buyer were to buy a home for and hold on for 2 years, 3 years or so, and they're not flipping it, then they're going to gain the money back in 2024, 2025. And take a look at the fixed rate mortgage. It is going to stay at around 6.6%. Now, if your client asks you whether it is going to go back when, are we going to go back to 3%? You can probably tell them, probably not in your lifetime. 3% is going to be tough. Now, if we actually get back to 3% or 2.5%, we should be worried because we will be in a deep recession, at least in the next few years or so.
I have a question. Do you think that in 2024 we'll see rates in the 4.5% to 5% range?
I think it will be closer to 5, or maybe 5.5. Probably not 4.
Okay.
Um,
Do you think we'll see it in 2023, or do you think we'll see rates stay 6s and 7s in 2023?
let me tell you what, I was going to actually, I didn't have a chance to do it. I was going to give you the projection over a period of time. I'll verbally tell you what it is going to be. Right now, it's about 7.5 or 7.2-ish or so, maybe. December, it's probably, the Federal Reserve will probably raise rates by 50 basis points, which is expected. So I think by the end of the year, we may actually hit 7.5 for 30-year fixed rate.
Okay.
Then moving into next year, early part of next year, we probably will top at, I don't think we will hit 8, but we actually may hit 7.75 at some point in March or April. I think that will be the top, and then from that point on, it probably will start leveling up. It may actually stay at 7.5 for maybe a few months, depending on whether we're going to see a recession. In the second half of the year, things are probably going to, the Federal Reserve will probably start lowering the rates. By the end of the year, I wouldn't be surprised by the end of 2023 that we'll see 6.5. And then in 2024, first half or second half of first half of 2024, you may actually see the rates dipping to 6%. And by the end of 2024, maybe 5.5, depending on how the economy will be behaving. So now that will be the trend line. I was going to actually increase the trend line for the price as well, but I don't have a chance to do it because with the timeline for the rates and the timeline for the price, you can actually figure out what the mortgage payment is, and you can kind of sense where it will be the toughest part of the market and when it will get better. My speculation is if you factor in the interest rates and everything and the price, sales actually may actually stay at a low level for April, May, June, July, and August because they're still a little iffy. Now, those are the typical buying season. I think we will have a tough buying season in 2023, but after that, interest rates start actually moving a little bit further, and people realize, okay, well, things are actually slowing down, things are actually getting better, and price will actually stay sort of level. So that's when I think, maybe in August or September, things actually start picking up a little bit. Now, this is, of course, under the assumptions that we don't have any surprises. We had some surprises earlier this year. I mean, I didn't expect a Russia and Ukraine war. So without any surprises, I think a third quarter or fourth quarter of next year, we may actually start seeing some things coming back. And interest rates will actually stay, it's not going to go back to 4% for a while, 4.5% for a while. Now that's the reason why buyers and sellers are sensing a lot of uncertainty during this period of time. Take a look at the chart up here. Buyers, when we ask in a consumer survey what kind of help they need, negotiating the price in terms of sales is one of the most the item that they ask for most help with. That's always the top of the list. Finding a property, providing expertise, and they're going to need more help in the upcoming years because they need to know, especially negotiating with sellers. Same for sellers, though. Sellers also need help with negotiating a term and sales and setting the right price. Absolutely, for the next year and a half, they need help with setting the right price. And so, taking all that into consideration, buyers and sellers, they all need help, and this is the time when we actually need need to be trusted advisors. Realtors need to be trusted advisors because we know about the mortgage environment, we know about what's going on with the economy, with interest rates, and sellers and buyers, they trust us to provide them very valuable advice, especially with the market moving so subtly, with the market moving so volatile, and there are a lot of economic noise. I'll repeat, it's going to be a tough, 6 months, 12 months or so. But keep in mind, as a trusted advisors, we're building long-term relationships with our clients. It may not necessarily be that they will buy anything like right away, but we are in the business for a long time, so it may be something to cultivate, in the next 12 months or so. Now, I never put the slide up before because I never put one up because people always ask me, what should we tell our buyers and sellers? And I don't. The verbal answer that I usually tell them is, well, there are a lot of things that you can say to your buyers and sellers. And people don't usually say, I would usually tell them, okay, well, for buyers, you can tell them, yes, market is going to, you might see actually a slowdown in the market with prices dipping, but interest rates will actually pop back up in the first half of the year. So if you don't buy now, you're going to lose out, on the mortgage payment anyway, because interest rates are going to increase. But that's my typical answer. But I realize that there's no typical answer because I just created the slide actually last night. There's no one size that fits all answer because you have first-time buyers, you have repeat buyers, you have investors, you have all cash buyers. These are the different answers that I think you should consider, when telling your buyers and sellers. I just gave you an answer for first-time buyer. When telling your repeat buyers, now you have different repeat buyers. Repeat buyers are sellers who actually plan to buy, or you have sellers who plan to buy or sellers who may not plan to buy. For sellers who plan to buy a home in the next 12 months or 20 months or so, there's one way you can tell them, well, for sellers, if you were planning on buying, maybe you should actually consider selling right now because of equity. Your equity is at a low level, at a high level right now. Still good time to put your house on the market, and then consider buying. Use your equity. For seller. Use your equity. Maybe I know it's a high interest rate right now. Maybe consider using your equity. Look at the chart that I showed you earlier. Use your equity to either put a bigger down payment or do a buy down. That's one way to tell your sellers to actually go back to the market, list your property, and buy. Now, what about for investors, buyers? For investors, there's a good opportunity in the rental market that I mentioned earlier. Why not, consider buying a multifamily home or buy a rental property? Some will be buying it for short term, some will be buying it for long term. But regardless, the long term rent actually has been the average rent has been growing by 8 or 9%. So that's a good opportunity for investors, buyers. Now, for people who are 55 or older, Prop 19. Let them know about Prop 19. That's a good opportunity. And what about investor? I put it up there also. Investors who want to flip, I'll tell them no, don't flip right now. And for cash buyers, all cash buyers, if someone say, hey, I'm buying with all cash, what should I do? I can tell them to jump into the market right now because they have all cash. If they want, all they care about is to buy a property at the lower price. You have to let them decide, that they might have to buy a property at a lower price, later. But I think, you have to consider, both the short-term gain as well as the long-term, relationship. I think that's one thing that we need to consider, as a market advisor, as a trusted advisor right now. These are some of the answers. I'm sure there are more answers to, the different buyers. Here are my concluding remarks. I already told you, sales, it's going to be tough in the next 12 months or 18 months or so. Sales are going to go down. We're going to see some economic uncertainty and market uncertainty. So that is something that I think we will have to kind of work through. The length of the challenge could be 12 months, could be 18 months, but I do believe that the economy is going to slow down, but not tank. We don't expect, what happened in 15 years ago, because people have actually built up some leverage. But the supply side will remain to be short, just like what I mentioned earlier, because people are actually holding on to their property because they don't want to give up. Even if they want to buy a home, they may not want to give up because it doesn't seem to make sense for people to trade up for 2.5% to 5 or 6%. But some of those suggestions that I made earlier, like maybe buy down or actually refinance, could be some options for buyers. Prices will probably drop. If your clients ask you about whether we're going to see some price change, yes, we are going to see some price change. But if you're holding onto your property, for 2 to 3 or 4 years, then it will come back up. The question is, if you find a property that you really like right now, do you want to give that up? You can always refinance. Another question that someone asked me, and I don't really have a very clear answer of, but maybe you guys can figure out, is someone may ask, if I were to refinance, if prices actually go down, am I going to be in a situation that I may not be able to refinance as much? Well, then I think one solution is make sure you pay your mortgage payment, maybe pay a little bit more, so to build up your equity. So when you refinance, you may be able to get into a position where you can get a low rate. And of course, rates. I already mentioned earlier what the rate trends are going to be. Of course, those are speculation. They could change, 6 months from now, but that's what I believe is going to be. And the final bullet point is yes, I think buyers and sellers both are going to need help, and then we're here to help. We're not here just to help them buy a home, but we're also here to help them build American dream. And with that, that is my email address, and if there is any, if we have time, then we can have a Q&A. If not, then
Does anybody have any questions for Oscar at this time? No? Well, let's give Oscar a big